Here's how you can buy a house with very little money down with credit scores as low as 500. It's called an FHA loan. And in today's video, we're going to discuss the 2023 FHA loan requirements. We're going to discuss some commonly asked questions around FHA loans. And if you stick around to the end of the video, we're going to show you how to do calculations with regards to FHA mortgage insurance on top of discussing the biggest difference in FHA from last year. Now, something I want to be very clear about early on in this video is that FHA loans are not just for first-time homebuyers. It's a myth I hear all of the time, and it's simply not true. In fact, you can be a buyer that currently owns other properties at the moment and still use an FHA loan to purchase a home. On top of that, FHA loans are not just for home buyers with low credit scores. So a lot of people out there believe that FHA loans are just for low credit score buyers and first-time home buyers. Both of those things are simply not true. Now, one other thing I want to mention before we actually dive into the FHA loan requirements is mention how flexible FHA loan guidelines are. It's probably the easiest loan to qualify for because it requires that minimal down payment, which we'll talk about here in just a minute. It also allows very low credit scores on top of allowing very high debt to income ratios, which means that you can likely qualify for more home using an FHA loan than any other loan out there. Now, early in the video, I mentioned that you can buy a home using an FHA loan with very little money down. So I want to take some time now and actually talk about the down payment requirements when using an FHA loan. So FHA only requires a 3.5% down payment when you're buying a home and you have at least a 580 credit score. So that means if you're purchasing a $100,000 home, your down payment is only $3,500. A $200,000 home, $7,000. $300,000 home, $10,500. $400,000 home, $14,000, and the list actually goes up from there. But at the same time, if your credit scores are lower than 580, which FHA actually allows, they allow credit scores as low as 500. So if your credit score is between 500 and 579, FHA is going to require at least a 10% down payment. So again, if you're buying a $100,000 home, that would be a $10,000 down payment. $200,000 home, $20,000, so on and so forth. Now, I often have people reaching out to me saying, hey, Jeb, I have a 580 credit score, and when I go into my bank and try to get a loan, they're denying me. They're saying that I can't actually get an FHA loan with a 580 credit score. So I want to take a moment here and actually talk about one of the downsides of FHA at the moment, and that's that a lot of lenders out there actually have overlays on their programs. What is an overlay? An overlay is essentially an additional guideline on top of what FHA actually requires. So FHA allows credit scores as low as 500. But if you go into your local bank's requirement might be a 600 or a 640 credit score. And the reason your bank does this is because it adds an additional layer of protection for them. Even though these are government loans, they're backed by the government, they want to add an additional measure of security, if you will, to make sure you're a more qualified buyer in their eyes, and so they add these additional guidelines. Now, that's one reason that I often mention working with brokers over banks is because brokers out there have access to multiple programs. They're not just tied to the programs that they have. If it doesn't fit the programs that they have currently with one bank, they can take it to another bank. So going with a broker will often open more opportunities, especially with lower credit scores. Now, if you're watching this wondering how do I get in touch with a broker, do me a favor, check the link in the description below. I'm happy to refer you to somebody I know, like, and trust that can guide you through that process. Another FHA loan requirement is that they require mortgage insurance, both an upfront mortgage insurance premium as well as a monthly insurance premium. Now, what does all of this mean? Well, typically speaking, when you put less than 20% down buying a home, you're going to have mortgage insurance. And FHA is one of those loan programs that requires mortgage insurance regardless of how much money you put down. So if you're putting 20% down, you're likely not using an FHA loan. But if you are using an FHA loan, you're not only going to have that upfront mortgage insurance premium that we discussed, but you're also going to have a monthly mortgage insurance premium that you pay every single month on top of your mortgage payment. And at the end of the video, we're actually going to do a calculation to show you how to calculate this upfront mortgage insurance as well as the monthly mortgage insurance. So if you're doing some back of the napkin calculations at home, you know exactly what to do. do. Now, one of the downsides of mortgage insurance with regards to FHA is that if you're only putting 3.5% down when you're buying that home, that mortgage insurance is going to stay on the loan for the life of the loan. Whereas if you had a conventional loan and you paid that balance down and you had at least 20% equity in that property, the lender in most cases is going to remove that mortgage insurance. FHA, unfortunately, will not remove it because it's one of the requirements when you're only putting 3.5% down. Now, if you are using an FHA loan and you put at least 10% down, the mortgage insurance will come off the loan, but only after 11 years. So you have to make 11 years of payments with that FHA loan, in which case that mortgage insurance would fall off after the 11th year. Another FHA requirement is that the home that you're purchasing must be a primary residence. It has to be a property that you're going to occupy as your primary home. It cannot be used as an investment property. Now, I often have people reaching out to me saying, well, how long do I have to stay in it as my primary home before I turn it into an investment property? And there's not a concrete answer, but the general rule is that you need to keep that home as your primary home for at least 1 year. And after the first year, you can turn it into an investment property. So the question of, can I rent it out after a year as an investment? The answer is yes. You can do it as an investment property after you've occupied it for at least 1 year. With that said, there is a workaround with regards to FHA and investment properties. One nice thing about FHA loans is that they not only allow you to buy one unit using FHA, which is 3.5% down, they'll also allow you to buy 2 units, 3 units, even 4 units with just a 3.5% down payment. So in the case that you buy a 4-unit property, you can actually occupy 1 unit as your primary home and rent the other 3 units out as investments in order to help you pay your mortgage. In turn, kind of house hacking, if you will. While we're on the subject of units, FHA does have an additional requirement where they have a max loan amount depending on the area that you're located in. Now, if you're in what they deem a low-cost area, your max loan amount is going to be $472,030. But the cool thing is, if you're buying units, that loan amount actually increases all the way up to $907,920 in a low-cost area for a 4-unit property. But at the same time, if you're located in a high-cost area like I am here in Southern California, a 1-unit max loan amount for FHA is $726,200. And you can go all the way up to $1,396,800 for a 4-unit property. Now, if you're watching this wondering, well, am I in a low-cost area or a high-cost area? Do me a favor. I put a link in the description below where you can actually check the county that you're in, and it'll tell you the max loan amounts for each unit. Now, earlier in the video, I mentioned how flexible the guidelines were with regards to FHA, how you can typically qualify for more home using an FHA than you can, say, a conventional loan or, say, a USDA loan. And it's because they allow you to use more of your debt towards qualifying than any other loan program out there. So with that said, FHA will allow you to go up almost to a 57 back-end ratio. What does that actually mean? Well, that means if you took all of your monthly debts, say your credit cards, your car payments, your student loans, whatever your monthly payments are, you add your housing expenses on top of that, which includes your mortgage, your taxes, your mortgage insurance premium, any HOA, any insurance. Once you add all of that up and you divide it by your gross monthly income, that's going to give you a percentage. And FHA will allow you to go to a 57 debt to income ratio. Now, there are some additional requirements with regards to the front end ratio, but when you're working with a mortgage professional, they can actually guide you through that process. Now, I know we're about halfway through this video, but I want to take a minute and introduce myself. My name is Jeb Smith. I'm a real estate broker here in Southern California. I'm not a lender. The reason I make this video is to give you an unbiased opinion of FHA, to give you the pros, the cons, if you will, tell you the ins, the outs, so that you have all of the information you need to make the right decision from you. Oftentimes, if you're listening to a mortgage professional or a loan officer talk about FHA, you feel like they're pushing you towards FHA because they get some benefit out of it, if you will. Well, when I make the video, I kind of take that out of it, if you will, and just give you, again, that unbiased opinion to provide some clarity and help walk you through that process. And with that said, I'd like to ask a favor. If you're finding any value in this video at all, do me a favor and hit that thumbs up. feel free to subscribe to the channel. I often talk about FHA, different real estate programs, as it's all about guiding you through that journey of home ownership. Now, one other FHA requirement that I wanted to talk about with regards to the type of property, not only does it have to be your primary residence, but the property also has to be FHA approved. Now, if you're buying a condo, that's where that really matters, because all single family homes, if you will, are already FHA approved, but there's a lot of condos out there that don't meet the FHA guidelines with regards to being approved. So if you're buying a condo, you have to make sure that property is FHA approved. Now, there are ways to get a spot approval, to get a particular unit in a building FHA approved if the entire complex is not approved. And in some cases, it's an easy, quick process. And in other cases, it's a complete waste of time. So just make sure you're working with a mortgage professional that actually understands FHA loans and can walk you through that process. With that said, if you need a lender referral anywhere in the United States, do me a favor, check the link below. I've taken the time to create a network of experts that understand FHA loans. In fact, they understand all loan programs, conventional, USDA, VA, FHA, what have you. And these are people that I know, like, and trust, and I know they will take great care of you. The last thing I want to talk about before we get into those mortgage insurance calculations and talk about the biggest difference in FHA loans this year is actually talk about employment and income. FHA loans, in fact, all loans have a requirement where you need to be employed for at least 2 years in the same line of work. Now, with that said, do you have to be employed exactly 2 years? No, you have to have steady income and employment. That means over a 2-year period, if you've been laid off, you've gotten another job, or maybe you took some time off because of something that happened with your health or what have you, those can be reasons that maybe you weren't employed. But typically speaking, you need to have at least 2 years of steady income and employment. Now, what you don't want is to go from being a wage earner to becoming self-employed without at least 2 years of experience. If you're going from wage earner position to wage earner position and it's in the same line of work, then typically you're going to be completely fine. But what I often see is people that have had a steady job for a long period of time and they've started a side hustle, and this side hustle has become their main hustle, and they've said, you know what, I don't need that other job anymore. I'm just going to do the side hustle as my main hustle, and now they're self-employed and they've only been doing it for a short period of time and they try to go get a loan. This often presents problems. So just make sure, if you're considering buying a home and you're doing one of these transitions, talk to a loan officer early in the process to make sure that there's not going to be any issues. Now, one of the questions that often comes up is how early is too early to start the pre-approval process? If I know I'm going to buy a home 6 months from now, should I start that process now? And the simple answer is yes. By doing it earlier in the process, you can work on things or not do things that maybe you were going to do that could upset you actually getting the loan. Oftentimes, you can work on things like improving your credit, maybe saving a little bit more money down that puts you in a better position. So by having this conversation early, you'll put yourself in a better position to actually buy a home. On top of that, one of the questions that I often get with regards to income and employment is asking, is there a minimum amount that I have to make, or is there a maximum amount I can make? And the answer is no to both. It doesn't matter how much money you make per month as long as you meet the qualifying guidelines, that debt to income ratio. And the same for a maximum income. You can make $1 million a year and still use an FHA loan as long as you meet the lending requirements that we discussed in today's video. Now, one more quick recap before we dive into those calculations, and I want to talk about the pros and the cons of FHA. The pros: they require a minimal down payment, they allow lower credit scores, and they have super flexible guidelines. But with that said, there's also some cons. Mortgage insurance likely stays on the loan for the life of the loan, as we discussed earlier in the video, as well as the home has to be your primary home, in addition to FHA also having loan limit requirements. So with all of that said, I wanted to take some time here and actually do that calculation that we discussed earlier in the video so that you can understand what the upfront mortgage insurance premium looks like, as well as the monthly mortgage insurance premium, so that if you're doing some calculations at home, you know how to calculate these. So let's say that you're buying a $350,000 home. With FHA, that only requires a 3.5% down payment, which in this case is $12,250, which means that your loan amount before you add that upfront mortgage insurance premium to it is going to be $337,500. Now, the cool thing with the upfront mortgage insurance premium that we're going to talk about here in just a minute is that FHA allows you to finance that. It's not additional money that you have to come up with out of pocket. But with that said, if you're only putting 3.5% down, you're essentially going to lose a portion of your equity by financing this upfront mortgage insurance premium into your loan amount, which we're actually going to talk about here right now. So your loan amount is $337,500. So here's how you actually calculate that upfront mortgage insurance premium. With FHA, it's 1.75%. So you're going to take that $337,500, you're going to multiply it by 1.0175, which is going to give you a base loan amount of $343,640. So that's how you calculate the upfront mortgage insurance premium. As you can see there, you were putting $12,250 down, but now you're financing $343,000. So a large portion of that got eaten up by that upfront mortgage insurance premium that you're financing. So on top of that upfront mortgage insurance premium, you're actually going to have a monthly premium as well. And how you're going to calculate that, you're actually going to take that same base loan amount of $343,660 and you're going to multiply that by 0.85%. So in this calculation, you're going to multiply it by 0.0085, which is going to come out to $2,921.11. And then you're going to take that amount and you're going to divide it by 12 because it's going to be paid every single month on top of your mortgage. So once you divide it by 12, that comes out to $243.43. So hopefully that's helpful. I'll put the calculations that we just did here in the body of the description if you want to go back and look at them. But finally, I want to talk about the biggest difference in FHA loans in 2023 versus 2022. And that difference is that FHA loans right now are a lot easier to get accepted than they were in 2022. In 2022, the market was moving so fast, sellers weren't even considering FHA loans because they had 5 other loans in their hands that weren't FHA, where people were putting a lot more money down and really pushing the FHA ones to the side. Well, in the market that we're in at the moment, a lot of homes are sitting on the market longer. A lot of sellers are having to reduce their asking price, and a lot of sellers out there just want to see an offer. So if you're a buyer out there and you're using an FHA loan, don't be shy in presenting an FHA loan to the seller, because I can bet you they'll just be happy to receive an offer. But if you watch to this point and you want some more information on FHA loans, do me a favor and check out these here.